Well, summer is here. It is a time that Americans typically spend, and with inflation still elevated and some indications that growth is slowing, what does this tell us about the state of the economy? Well, joining me now with more is Caleb Silver, editor-in-chief at Investopedia. Caleb, it's good to have you.
Good to be here.
So I know that you've looked at some recent spending data. What is that telling you about the consumer and the economy?
Yeah, we're getting a little tapped out here. If you listen very closely to the results from a Target or even a McDonald's, they're lowering their prices. Even Walmart is saying people are going with lower ticket items, even going discount in the grocery part of the Walmart, which tells you that we're just pinching our pennies. Higher prices are cured by higher prices because eventually consumers get tapped out. We're starting to feel it, and if you look at consumer discretionary stocks, they have not participated in the stock market rally. Of course, the biggest are Tesla and Amazon, but other consumer discretionary stocks will tell you that the consumer is just not as strong as it was. We're still paying for travel, we're still going on trips, we still want experiences, but the day-to-day spending is starting to get slimmer because we have record high credit card debt, and I think consumers are getting a little bit exhausted, tough going into the summer season.
Did it surprise you to hear comments from Fed official from Minnesota, Neil Kashkari, earlier that he thinks rate cuts are perhaps not on the horizon this year, might even see rate hikes?
Yeah, he's been pretty consistent about saying that, and he's been one of about 2 or 3 Fed presidents that have been saying that, and I think that's just tempering expectations for a potential cut. And for investors, a cut is not always the best thing to happen for the stock market. It usually is a signal that something is not going that great. So inflation's still stuck around 3.5%. We're going to get the PCE this week for the month of May. That'll be important because that's the Fed's preferred measure of inflation. That's just going to tell us that we're not getting deflation, we're getting some disinflation. The rate of growth is slowing, but I think people, consumers, households, investors need to get used to this higher until whenever in terms of interest rates and inflation.
How important is consumer confidence to the way that consumers spend?
Yeah, it's important, but consumers will say one thing and do another. So if you talk to anybody about their number one concern going into the election, they'll say the economy because it's the easy thing to say, and it's the thing we all feel. Consumers say they're feeling tight, they're having trouble getting by week to week, but if you look at what we're spending our money on, last summer it was the Beyonce concerts and Taylor Swift, but still it's a lot of airline travel and it's a lot of dining out. Both of those things have gotten pretty expensive. A little relief in airline prices. So we're spending on experiences, but we're not spending on the day-to-day things around the consumer discretionary sector, and that's going to weaken us. 70% of U.S. GDP is consumer spending. We're professional spenders in this country. We have to keep doing it in order to keep the economy going.
I'd be curious to get your take on earnings season. By and large, most of these companies exceeding expectations. That is usually what happens.
That's usually what they do.
And May a pretty decent month. Do you see signs that the momentum in the stock market can continue?
Yeah, for investors, look, higher highs always scare people because things seem expensive. But you know what usually happens after higher highs? More higher highs until we hit some sort of a roadblock or a gray swan event. What's that going to be? It could be consumer spending. It could be uncertainty around the election. It could be just lingering inflation that taps us out. But in general, the stock market has been a pretty good place to be for investors, even though it's a little bit imbalanced right now. But this is a golden era for investors where you have companies buying back their shares, issuing dividends for the first time, or increasing their dividends. That's a very big deal. And you got profits growth, and you're going to have a Fed rate cut eventually. That's a sweet spot for investors.
And I can't tell you how many times I hear from traders down here on the floor of the stock exchange that have been here for decades that it's an election year. And history tells us that typically during election years, stocks do well, don't they?
They absolutely do. And it really doesn't matter who ends up sitting in the White House. It's pretty split either way, maybe 12% for Democrats, 11 or 10% for Republicans, but it's about the era, not about the person in the Oval Office. Now, if someone goes into the Oval Office and starts cutting taxes, especially for the wealthy, and you get people, being able to invest with impunity, you'll see the stock market continue to rally. But in general, it's the uncertainty, and I think it's the chaos around the election, not the actual result of the election, that freaks people out.
We do have a Fed meeting and rate decision in several weeks in early June, and we will get another read on inflation, the PC index, on Friday. What do you think are the most important takeaways from that data point on Friday?
Yeah, I mean, it's going to be about whether or not spending, and we're going to get the personal income report on Friday as well. Is it keeping up with this inflation stuck at 3.5%? Because inflation's not really going anywhere. Higher energy prices have a lot to do with that, but everything is more expensive. Insurance is more expensive. food is more expensive, rent, shelter, all more expensive. So the question is, what are the words? Because words matter when the Fed delivers its results on interest rates. Are they talking about waiting to see more and being data dependent, not seeing what they need to see yet? Those are the types of things that get people a little bit agitated around Fed decision. But the Fed's not touching rates until maybe September, if they touch them at all this year. And again, be careful what you wish for if you're hoping for the rate cut, because it doesn't always translate into higher stock prices.
I think that is a really good point, because we've seen stocks rise quite dramatically to the upside in just the past 18 months or so. And I think the hope is that lower rates mean higher stocks, but perhaps a change in direction that we could see in the wake of that. I'm curious to get your take. Obviously, the unofficial start of summer happened over the weekend. Things that consumers and investors should be aware of as we head into these summer months from a budgeting perspective, even an investing standpoint.
Yeah, so get used to just higher prices. This is just the way it is, and be careful about your spending. We do have record high credit card debt, we know that, but income has also grown with that as well. It hurts people on the lower income side the most. Watch spending across the staples, because the staples have been impacted right now. You see the stock market at or near record highs, but again, consumer discretionary, not a part of it. Staples trying to keep up with that right now. If spending drops, you're going to see the whole market sort of maybe lose a little bit of those gains that we've had in the past month or so.
So we've seen a lot of positive data points. We've been discussing earnings, other economic factors like disinflation, higher stock prices. But that latest GDP report that we got was lighter than economists had expected. Is that any cause for concern?
Yeah, I mean, the economy is still growing, so we're not in a recession from a technical perspective. Just the growth is not as torrid as it was. So if you have a lower growth rate, but you still have companies able to book profits right now and buy back their shares and issue dividends, that's a pretty healthy place for investors to be. It's a pretty healthy place for public companies. Let's see if that momentum and all that money that's sort of in money markets right now earning 5% wants a little piece of this stock market action near record highs.
We've been talking so much about high yield savings accounts during this high inflationary environment, but I want you to talk more about the safety of money markets that you just mentioned, because typically they do yield a little bit higher than some of these savings accounts.
Yeah, 5.5%. And so we went for a long period of time where there was TINA. There is no alternative to stocks because rates were so low. Now with rates higher, and they've been this way for a couple of years, we have TARA. There are lots of alternatives, right? Plenty of alternatives where you could invest in money markets right now if you want to park your money. You could chase high yield bonds if you're trying to get 8%, or you could sit in the stock market and enjoy this 12% rally we've had so far this year. We've had an incredible rally since October of 2022. So money markets attract safety, and we know we have a lot of older investors out there that want to protect their nest eggs. That's where you've seen about $6 trillion. It's not like that money's going to go flooding into stocks, but some of it will want to chase higher returns.
Is it insured in the way that a high yield savings account is FDIC insured?
Yeah, to a point. Now, it's a different insurance. It's SIPC insurance. That's a different type of insurance. But yes, your investments are insured to a point, just like they are in the bank to a point. Now, you might have to have several money market funds at different yields to make sure they're all protected, but they are protected for investors.
All right. Caleb Silver joining us here on this Tuesday. He's editor-in-chief at Investopedia. Caleb, thank you.